Hi, this is Meetime Television covering United States stocks. This video is a simultaneous release with Mijihun Television. Today in the United States Blue Chip Stock Analysis segment, the stock we'll be covering is HIMSS and Health. As you can see from the English name, HIMSS refers to men, like those guys, and Health refers to women. So it's a company that creates health services for both men and women. You can tell this from the company's name. This company targets what you could call patients. It's a platform company that connects consumers and medical professionals through a telemedicine platform and offers services like prescription subscription services. In the Blue Chip Stock Analysis segment, we'll be looking at things based on 4 questions, and we'll mainly explain things centered around data-driven content. So it would be good if you could separately check things like the sentiment of the news or recent news about the company and make a comprehensive judgment about the company. Let's take a look at the recent stock price trend. The stock price has risen tremendously. So the name of this company kept coming up in the system, but since it wasn't a very large company, I used to ignore it. However, it's one of those companies whose stock price has risen too much to ignore. Compared to the 52-week low of around $13, the stock surged by 441% to nearly $70. However, when it corrected at the end of December, it dropped by 67%, which could have been very painful for those who bought at that time. So companies with high growth rates but relatively small market capitalizations can experience this kind of volatility. So those who invested earlier here must be very happy, and these are the kinds of investments you should look for. That's the explanation you'll hear, and those who bought at this time faced a lot of company risks and constant major issues. But as the stock price rises, some of those concerns tend to disappear. So you have to understand that stock prices are bound to fluctuate a lot. When prices go up, people stop focusing on risks and only good news comes out. But when prices fall, it looks like they'll fall forever. Being able to distinguish between noise and actual facts is one of the most important skills for an investor. So while we can't cover everything in this stock analysis segment, we do keep adjusting things like the company's risks or other factors by continuously updating the earnings per share and future earnings forecasts. So it's not true to say that we don't reflect those factors at all. They are being reflected. Whether it's excessive or not, we judge that based on the data. But there are still qualitative areas that the data itself can't capture. That's something that should be left to you, the investors. The system can't do everything. So even when the same information or news comes in, everyone can make different judgments about it. If everyone judged the same, stock prices would move in only one direction. People react differently to falling prices, some buying and some selling despite having the same information. Judgments and systems can vary. So just because I'm introducing this stock to you, it doesn't mean I'm telling you to buy it now. Why don't I talk about the bad news? Rather than leaving comments like that, it's better to realize that there are companies like this to understand their strengths and weaknesses and to see what the data says. That way you can improve your ability to make judgments based on data. If you use this video content in that way, it will help us explain the purpose of creating this segment. Yes, if you look at this company, it's an online-based digital healthcare platform, mainly focused on sexual health and hair loss. So what I wrote here in English isn't something I made up. It's actually displayed right at the top of the company's website. So when it comes to personalized sexual health and hair loss treatments, they mainly started with issues related to erectile dysfunction. Focusing on erectile dysfunction and hair loss for younger people, this company began offering personalized digital care in San Francisco in 2017 and quickly became one of the fastest growing companies in the field. Naturally, when you hear about it like this, they started with an item that makes people think, if this solves my problem, I'd be willing to pay for it. And then they gradually expanded into areas like weight management, skincare, and mental care, just like they're expanding now. So at first they started as a service just for HIMSS, but now they've expanded to hers as well. It's a platform that's growing even further into areas like mental health and similar fields. That's how we can sum it up. The company primarily operates through a direct-to-consumer D2C model to reach their customers. Through this platform, they provide online consultations, prescriptions, and even deliver the medication. The main service model earns money by matching users with the platform, but they are making a lot more profit after introducing a subscription service. So there are cases where you need to keep prescribing the same medication repeatedly. In those cases, it's a company that makes money through a system where you subscribe monthly or quarterly, get your prescription, and have the medication delivered to your home. Now, the main point behind their recent growth is right here. This company is entering the glucagon-like peptide, one-weight management compounding drug market in 2024. And the reason why this is important is because there are usually certain companies that come to mind when you think of weight management. Companies like Novo Nordisk or Eli Lilly, with products like Wegovy, have faced situations where the supply of these products couldn't keep up with the demand, according to the Food and Drug Administration. So, while demand is exploding, the supply just can't keep up. In relation to this, the Food and Drug Administration allows compounding drugs, and these don't require Food and Drug Administration approval. So, what are these compounding drugs that are made and sold? They don't need Food and Drug Administration approval. When official products are in short supply, pharmacists can make small amounts of unofficial, customized mixed formulations based on a doctor's prescription. We call these compounding drugs. Companies are entering this compounding drug market to help with weight management for people who want to lose weight but can't get Wegovy due to supply shortages. These compounding drugs are made to have the same effect. By entering the market in 2024, this company will experience a huge explosive growth. This can be considered one of the risks for this company. So you need to pay close attention to this. If the Food and Drug Administration regulates something that is a key point for the company's growth, they will review regulations on these aspects. Or, for example, they might say not to use compounded drugs related to weight anymore and only use officially approved emergency drugs or similar cases. Or even if there's just news that they're reviewing it, there's a risk that the stock price could drop by 20% in a single day. So clearly those aspects are a huge growth driver for this company, but at the same time they also carry risks. That's how you should see it. Currently, the company doesn't disclose the exact sales proportion of its compounding pharmaceuticals, but based on what's shown in the business report, the industry estimates it to be around 20%. So, although the compounding pharmaceuticals market has grown tremendously, if this growth were to stop, there's definitely a risk that the stock price could plummet sharply if this level of growth disappears. So, I think it would be good to look at the risks from this perspective. As for growth, aside from compounding and pharmaceuticals, there are definitely areas that are growing based on these basic models. So I think it would be good to focus on these aspects. If you look at whether it's a blue chip company, it scores 80 points, which is quite high. So its growth potential is also high. If you look at the data from a year ago, although it's a bit blurred here, you can find it on Choice Stock if you search. This was the evaluation of the company at that time. The expanded scope has enhanced the company's growth potential, financial stability, profitability, and cash generation capabilities. So if you look at the scores from the past year, you can see that it has grown quite rapidly. There aren't many companies that are growing, but this is a growth company that is actually improving its scores like this. That's how you can see it. Even on an annual basis, if you look at the sales and profits, you can see a sharp increase here as they jumped up. In particular, in 2024, the company experienced significant growth by entering the pharmaceutical market related to weight loss, which led to a substantial increase. Even just looking at the operating profit margin, it's about 6.1%. As the operating profit margin steadily improves, both profit margin and sales are increasing, leading to rapid growth in overall profit size. This is how you can view the company. As you can see, the net profit margin is relatively high at 9.2%. Previously, the operating and net profit margins were nearly identical, but now there's a disparity. If this persists, the net profit margin will surpass the operating profit margin. However, if the gap closes, the net profit margin will decrease, bringing it closer to the operating profit margin. So you need to judge these things based on the income statement, and we'll take a look at that a bit later. In the cash flow statement, operating activities are positive, while investing and financing activities are negative. Positive numbers indicate cash inflows, and negative numbers represent outflows. If a company consistently generates cash from operations and has negative investing and financing activities, it meets the cash flow criteria for a blue chip stock. Next, when looking at the valuation using the price to sales ratio, this company was traded between about 4.0 and 2.0, but at the end of the year, it was traded lower than that. And when the stock price dropped, it was traded at a cheaper value. Right now, it's at 7.1, which is higher than the previous peak. What this means is, unless the sales growth rate is higher than when it hit its highest point, it will be difficult to maintain this valuation. That's what we can infer. So I'll cover this indicator a bit more when we talk about valuation. If you look at the stock price and earnings per share chart, you can see that earnings per share is going up and has grown a lot. I mentioned that there was tremendous growth in 2024, and this is how it grew. Earnings per share increased significantly like this. Consequently, the stock price turned volatile. Enduring this high volatility is crucial, or your overall returns would have suffered. If you look at it now, the stock went up to this point, then dropped by about 60% and then surged again. This company has this kind of movement. So when you invest in this company, it's not unusual for the stock price to suddenly drop. Especially the risks I mentioned earlier are very important, so it's crucial to keep looking for those kinds of articles and keep following this stock. Because when something becomes an issue, there can be significant stock price corrections. However, when the stock's valuation is low, it doesn't drop as much. Because when the stock price has already dropped a lot, it means that even those issues are already reflected in the current price. But right now, since the stock price valuation has risen to a certain level, if news like this comes out, the impact could be quite significant. That's the level we're at now. If you look at the expected performance and valuation, it's 58% this year, so following last year, the sales are showing tremendous growth. Next, the earnings per share growth rate is 32%, which is relatively low. I'll talk about this part as well. The stock grows by about 20% annually, with profit, earnings per share, growing by 43% and 30%. Given this high level of growth, the securities industry considers it a high growth stock when predicting its current growth. If you look at the valuation, because the growth rate was very high, it often traded at extremely expensive prices. In reality, there were hardly any undervalued parts, except for a few areas that dropped unusually. At this time, around October 2024, the yellow highlighted area was when it reached a somewhat reasonable price level, and then it became highly overvalued again, and then dropped again around April 2025. At that time, I thought it would be okay to introduce it if the stock price adjusted a bit, but it didn't drop that far and has surged again, so now it's highly overvalued once more. So even though the company's value is rising, at the moment the price is a bit too high to get involved comfortably. At this point, even a small piece of bad news could cause the stock price to fluctuate greatly, and on the other hand, it would take some really good news just to make it go up. Just looking at the valuation, it's definitely a price that's a bit burdensome to buy at. But earlier, I mentioned that the company is growing through those platforms, and things like monthly subscriptions and class fees are steadily growing. While the areas that grew rapidly do have risks, it's important to consider how much value to assign to these fundamental parts when you separate out the high growth but risky segments. It definitely seems to be at a somewhat expensive price currently. If you look at the momentum analysis, you can see that the stock price fluctuations are quite severe here as well. According to the exponential moving average chart and technical analysis, there was a buy signal around May 2014 indicating good supply and demand. However, the price is considered expensive compared to the company's value. I'll go to the website and take another look for you. Hints and Hills went up about 4.2% yesterday as well. So compared to the market, that's quite a big increase. It's pretty volatile. This company couldn't buy again after the initial sell signal. It seems like after cutting losses once, it couldn't be used again. The price remained high throughout. There might have been a chance if it had been included when it dropped recently, but so far that hasn't happened even once. Looking at the valuation, it was only included once at this price, and if the numbers had lined up back then, a buy signal could have come out, but we missed it at that time. Later, it probably needed to drop a bit more to catch it, but because it surged suddenly, we couldn't get it. A system can't catch everything. That's why you can't trust it 100%. Especially when you do this the same way. It boils down to the probability of getting things right. That's very important, and similar things it would be good to focus on and make use of those parts. We already looked at the stock analysis earlier, so if you look here, you can see this small, sharp, white part sticking out like this. The darker value that results from subtracting last year's value from the total is this year's value. So if I compare them for you, it has increased a lot like this. The growth score went from 55 to about 85, monopoly power also increased a bit, financial soundness reached 100, and profitability keeps rising along with improved profit margins. Cash flow generation has now reached 100, and you can see the trend here.
This is the data you can see.
Next, the growth rates are here. So if you check here, you'll see that this growth rate data keeps changing. The estimates for these growth rates will keep being adjusted as they reflect the company's risks as well. Because, for example, let's say earlier the weight management products can no longer be sold, so it looks like about 10% of sales will be lost. Then, of course, all these parts will be adjusted. This part will be adjusted, and that part will be adjusted, and the valuation will be adjusted just as much as the company's value drops. So after the adjustment, it's very important to keep judging whether the stock price is excessive or not, whether the market is overestimating or underestimating, and to keep making these assessments. Since every company inevitably has risks, it would be good to assess those aspects. I'm not telling you in advance whether this company has risks or not. I'm explaining how you should interpret things based on the data. Lastly, let's move to the financial section and look at the annualized figures here. The annualized figure is the sum for the most recent 12 months. As shown, operating profit has risen steadily and rapidly, surging notably from 2024 onward. This part is growth driven by products related to weight loss. And if you look here, you can see that net profit is higher than operating profit. Usually you don't see cases like this. Normally it's all shown as a negative, but if you look here, corporate tax is marked as a negative like this. Corporate tax used to exist in the past, but now it's negative. Negative corporate tax means no corporate tax was paid. It's negative because they either got that much refunded, or in accounting terms, it's written as if they got it refunded. Since you always have to pay corporate tax when there's a profit, as I showed you earlier in the chart, when you look at the profit margin, the chart spreads out like this, and the net profit margin is much higher than the operating profit margin. This wasn't the case before, but suddenly this section is showing a high margin. The question is whether this will continue, and the answer is no. Once the corporate tax issue is resolved, the net profit margin will decrease to match the operating profit margin. So the net profit margin will drop from 9% to around 5%, but if the operating profit margin continues, it will go up along with it. In any case, that high margin can't be maintained forever. Why? Earlier, it was about corporate tax. Let me check this by quarter. If you look at the most recent quarter, you can see they paid corporate tax. In the past, it turned negative, causing net profit to exceed operating profit. In the most recent first quarter, operating profit was $58 million and net profit was $49 million, indicating corporate tax has been paid. If this continues, net profit margin will decline. There are mainly two cases where corporate tax goes negative. One is when they received a corporate tax exemption, and the other is what's called deferred tax assets. I think I mentioned this once in the beginning of the show, but it's kind of like this. When a company incurs a loss, instead of making a profit, it's recorded as an accumulated loss. Wow. So if you say this isn't making money, but later on, the asset starts generating income and it's certain that it will make a profit, then you dispose of it and remove the deferred tax assets. That's how it's processed as a negative in corporate tax. So it's a bit of a difficult concept, but in any case, no actual cash comes in, according to accounting. It's just that the loss that was recorded in the books is reversed as corporate tax in this way. So when there is a profit, it disappears again. So you can think of it as things returning to normal. Recently, if you look at the stock price trend on the exponential moving average chart, it's actually in a pretty good shape, as you can see here. However, these kinds of sharp drops can happen at any time. From what I see, there are about two main risks right now. One risk is that the weight loss drugs I mentioned earlier could face regulations from the Food and Drug Administration in the future. This is the biggest risk. The second risk is that the valuation is too high, so there is a risk because of that. So this company could also plunge sharply if there's any external shock, news, or if its earnings fall short because of those risks. However, since I've already introduced the business model and such, and as I mentioned earlier, this segment isn't about recommending you to buy the stock right now, regardless of the price. There could be periods where you can enter at a better price like this, so it might be wise to wait for those opportunities. If it were me, that's what I would do. First of all, I hope this video helps you in introducing new companies to you, and through this stock discovery segment, in understanding how to look at data and how to use things like valuation effectively. If you found this helpful, please subscribe, like, support, and comment. Thanks.